Imagine a direct conflict breaking out between Iran and allied forces from the United States and Israel. Their militaries hold overwhelming firepower, air superiority, and massive missile silos. But Iran doesn't need to match them tank for tank to cause severe damage. It holds a single geographical advantage. The global economy relies on a single stretch of water in the Middle East, the Strait of Hormuz. At certain points, this waterway is just 60 miles wide, yet nearly a quarter of all global oil and gas shipments flow through it every single day. To avoid collisions, massive tankers carrying millions of barrels of oil have to navigate a specific network of tightly defined shipping corridors. Iran knows exactly where those narrow corridors are. The country's Islamic Revolutionary Guard Corps issued a clear warning. If a conflict escalates, they will block every single liter of oil from passing through. The resulting supply shock is engineered to drive the price of oil straight to $200 a barrel. A $200 barrel of oil jumps out of the realm of foreign policy and lands directly on your bank account. When prices experience a sharp, sudden rise at the source, the costs of food, transportation, and manufacturing surge right alongside it. Blocking the strait doesn't require a massive naval fleet. Iran utilizes asymmetric warfare, deploying specialized vessels to lay hundreds of deadly explosives in the water. They back this up with fleets of explosive boats and shore-based missile batteries pointed directly at the shipping lanes, turning a highly profitable passageway into a death trap. U.S. forces could deploy advanced equipment to clear the mines and attempt to escort ships safely through the water. But removing the physical danger does not mean the supply of oil immediately starts flowing again. Commercial shipping companies rely heavily on insurance to cover these highly valuable vessels. When geopolitical tensions erupt into a localized war zone, insurance providers react immediately. They either raise their premiums to completely unaffordable rates, or they pull coverage entirely. Without that financial safety net, massive shipping conglomerates will simply anchor their fleets. They will not send a multi-million-dollar tanker full of highly flammable crude oil into a hostile corridor unprotected. The physical threat of mines and missiles does its job by creating intolerable financial risk. The supply chain effectively paralyzes itself before a single shot is ever fired at a stranded ship. This paralysis hits the financial sector instantly. Oil is heavily traded on futures markets, where large companies and hedge funds buy contracts to secure oil at a set price for a future date. They are constantly trying to predict tomorrow's scarcity today. This animated line chart shows how an oil price spike occurs drastically ahead of any physical supply drop. When there is any indication a crisis might happen, traders rush to buy contracts at higher prices to get ahead of the expected shortage. This creates a snowball effect, pushing the price of oil upward, even if the physical supply on the market hasn't actually decreased yet. Momentum takes over. As more traders jump in hoping to cash in on the volatility, the price climbs higher. It is this psychological panic, driven purely by the pursuit of profit rather than immediate scarcity, that accelerates the cost until it crosses the $200 mark, completely decoupling from the baseline supply. Because petroleum products power nearly all forms of global transport, this massive hike instantly surges operational logistics. For massive ocean cargo ships, for international cargo air freight, and domestic trucking routes that deliver goods to your local stores, all suddenly require drastically more money just to operate. The speculative panic on Wall Street acts as a tangible worldwide tax. Every physical item that needs to be moved across a distance becomes significantly more expensive to transport. Companies cannot absorb those extra operational costs on their own. To avoid going bankrupt, manufacturers and distributors pass the burden down the supply chain until it lands on the retail shelves and ultimately on the consumer. The typical tank of gas for your daily commute, everyday household essentials, and the average weekly grocery bills suddenly take a massive bite out of your paycheck. This flowchart outlines the macroeconomic trap. Surging oil costs lead directly to rapid inflation across the entire economy. To cool that inflation down, central banks around the world respond with their primary tool, raising interest rates. This instantly leads to increased borrowing costs. With higher interest rates, mortgages, auto loans, and credit card debt become much more expensive to maintain. The average household is left with far less disposable income, severely restricting their spending power. Consumers stop spending, and businesses buckle under the pressure of high operational costs and low sales. This combination of sky-high checkout prices and crushing borrowing costs stalls out growth, triggering a severe and prolonged global economic recession. Governments do have emergency tools available. Many maintain strategic petroleum reserves, stockpiling massive amounts of crude oil designed to be released into the market if international supply shrinks. But these reserves are strictly temporary. The world consumes over 100 million barrels of oil every single day. Stockpiles can stabilize markets during a brief delay, but they are physically incapable of offsetting massive daily losses if a major waterway remains closed for weeks. Countries are also investing in renewable sources, like solar and wind energy, which can certainly help prop up local power grids. Yet the current green infrastructure lacks the sheer scale needed to suddenly replace the millions of barrels of international oil shipments lost in a conflict. Protecting against these global economic shocks requires long-term, aggressive energy policies to minimize reliance on imported fuels, rather than leaning on quick fixes when a crisis is already underway. Until the world fully transitions its energy grid, the physical and financial flow of global trade remains tied to geography. The stability of the modern economy will continue to depend entirely on safe passage through a fragile 60-mile stretch of water.